Welcome to Stock Incubator. Today we are breaking down the market question behind this story. One jobs report changed the character of the entire week. U.S. payroll growth came in at just 57,000. The unemployment rate held at 4.2%. On paper, that sounds like a cooling labor market. In practice, it triggered a much bigger question. Is the economy slowing fast enough to force lower rates, or is growth simply losing momentum while asset prices stay far too rich? That tension hit tech, hit Japan, pushed money into India, revived the gold bid, and dragged investors back into the old macro desk trade all over again.
One jobs report changed the character of the entire week. U.S. payroll growth came in at just 57,000. The unemployment rate held at 4.2%. On paper, that sounds like a cooling labor market. In practice, it triggered a much bigger question. Is the economy slowing fast enough to force lower rates? Or is growth simply losing momentum while asset prices stay far too rich? That tension hit tech, hit Japan, pushed money into India, revived the gold bid, and dragged investors back into the old macro desk trade all over again.
Start with the number that mattered most. Total non-farm payrolls rose by only 57,000 in June. That is not a disaster by itself, but it is weak enough to reset the tone. The deeper issue is that the prior 2 months were revised down by a combined 74,000. That means the slowdown was not just a one-day headline. It was a softer trend. The unemployment rate held at 4.2%, so this was not a panic print. But it was soft enough to crack the idea that the economy could keep absorbing high rates without friction.
Why did that matter so much? Because the market had been living on two beliefs at once. First, that growth could stay decent. Second, that the Fed would still have room to cut later in the year. A weak payroll print forces those beliefs into conflict. If growth is slowing, cyclicals and consumer names need a harder look. If the Fed gets pulled toward easier policy, the dollar loses some edge and hard assets regain their shine. That is why this week did not feel like a normal macro desk wobble. It felt like a rotation test.
The first place that tension hit was tech. The AI trade did not collapse, but it lost its automatic immunity. Once the market starts worrying about slowing growth, expensive leadership gets judged more harshly. That is especially true when positioning is crowded and expectations are extreme. This week reminded investors that even the strongest narrative trade can wobble when the macro desk backdrop changes. The message was simple. If rates drift lower because growth is weakening, that is not always a clean bullish signal for every high multiple winner.
Japan gave the cleanest international read-through. The Nikkei 225 dropped 2.5% to 68,733.15. AI-linked heavyweights led the damage. Tokyo Electron fell 7.44%. That is what contagion looks like. When Wall Street's tech leadership wobbles, Japan's high-beta AI chain often moves even harder. This matters because it tells you the week was not just a domestic jobs story. It was a global repricing of growth-sensitive leadership.
India told a very different story. The Nifty 50 finished near the day's high at 24,175.7, up 169.85 points, or 0.71%. Even more interesting, the Nifty IT index surged nearly 5% and snapped a 4-session losing streak. That contrast matters. Japan was hit by AI contagion. India benefited from rotation and bargain hunting inside quality tech and domestic growth exposure. Capital did not leave risk altogether. It changed address.
The softer labor print also hit the dollar narrative. When a market starts leaning toward easier policy, real yields matter more, and gold starts breathing again. That is exactly what happened. Gold moved toward a weekly gain as the weak jobs data reduced the pressure for a hawkish path and weakened the dollar. This is why gold mattered this week. It was not just a commodity bounce. It was a confidence signal that investors wanted something less exposed to earnings disappointment and less dependent on perfect growth.
Silver added a more aggressive version of the same trade. The metal pushed to roughly $62.39 per troy ounce. Silver always carries a double personality. Part of it is monetary. Part of it is industrial. When it rallies alongside gold, it often tells you investors are chasing both protection and cyclical optionality. The physical market remains tight, and the multi-year deficit story still gives the metal a scarcity argument. This week, silver was not background noise. It was part of the risk rotation.
Oil did not join the panic camp. Brent hovered near $72 and WTI near 68 to 69. That stability matters because it says the market still sees geopolitical and supply support under the surface. U.S.-Iran peace efforts helped cap the upside, while OPEC production increases and resumed Gulf shipments kept the supply story active. For traders, that means energy did not confirm a recession scare. It stayed firm enough to keep the inflation conversation alive, even as labor data softened.
Crypto gave a simpler message. Bitcoin held around 62,138. Ether hovered near $1,624.95. Those are not explosive levels, but they matter because crypto remains a live gauge of liquidity appetite. If macro desk stress had turned into full de-risking, these assets would likely have cracked harder. Instead, they stayed in the conversation. That tells you the week was a rotation, not a liquidation event.
So where did money go? Out of crowded certainty and into relative resilience. Gold and silver caught a bid. India caught incremental love. Energy stayed supported. U.S. megacap tech lost some of its aura, but not its entire throne. That is the real lesson. The market did not choose one clean macro desk outcome. It spread capital across slowdown hedges, selective growth, and real asset protection. That is why this was a rotation week instead of a pure risk-off week.
The bull case is still alive. A softer labor market can cool the economy without breaking it. If the Fed gets more room to ease and earnings hold up, the market can treat this week as a healthy reset. In that world, gold's strength is not a warning. It is a companion trade. India's strength is not random. It is a sign that capital still wants growth. And the AI wobble becomes a shakeout rather than the start of something much worse.
The bear case is harder to ignore now. Weak payroll growth and downward revisions could be the early warning signs of a broader slowdown. If the labor market weakens further, consumer demand gets tested, earnings estimates start slipping, and expensive leadership loses the cushion it has enjoyed for most of the year. In that world, this week was not a reset. It was the first crack in a crowded trade.
What proves the rotation story right? Gold keeps holding gains, the dollar stays softer, and next week's macro desk releases confirm that growth is cooling without collapsing. What breaks it? A snapback in yields, a reacceleration in inflation fear, or earnings commentary that says demand is deteriorating faster than the market expects. That is why the next week matters so much. This week delivered the shock. Next week decides whether that shock becomes a trend.
The cleanest way to frame this week is not panic and not celebration. It was a handoff. The market moved from narrow certainty toward broader caution. Jobs missed. Tech wobbled. Japan felt the spillover. India caught the benefit of rotation. Gold and silver regained relevance. Oil stayed firm enough to complicate the inflation story. Crypto stayed liquid enough to avoid a full stress signal. In other words, this was the week the market rotated. If you want the part that matters next, the real trap is not behind us. It is the proof window waiting next week. This content is for educational and informational purposes only. It is. We do not provide recommendations to acquire or dispose of any security, nor do we issue valuations or future valuation forecasts. Please consult a certified financial professional before making investment decisions.